A leaked bank memo just told big institutions to exit silver. And the timing is the part that should make your stomach tighten. Because this didn't happen after a crash. It happened while physical delivery numbers are screaming, we want the metal, not the paper. And it happened right after margin rules got jacked up twice. The exact move that normally kills a silver rally on the spot. So why didn't it die this time? That's the question we need to sit with, because the answer points to something bigger than price. And it points to who is cornered. I'm John A.G., and on this channel we don't gamble. We measure, we watch the plumbing, and we protect our downside. Quick disclaimer, this is educational. We manage risk. Now let's go straight to what actually happened. Before the margin hikes, the game was simple. If you had roughly 21 grand sitting in a futures margin account, the cash could control one full silver contract, 5,000 ounces. At 60 bucks an ounce, that's about 300 grand of silver exposure. That's leverage with a matchstick under a gas can. And when silver starts running, leverage turns normal traders into temporary heroes, right up until the exchange changes the rules. That's exactly what the exchange did. 2 margin hikes. First one was a solid punch. Second one was a haymaker, around 30%. And the second hike hit right after Christmas when people are distracted. Thin liquidity is everywhere, and the market is basically a hallway with no exits. If you were running contracts, you woke up to a message that said, add a lot more collateral or we liquidate you. No debate, no mercy. So what happens next is mechanical. Forced selling. If you don't have the extra margin, you cut positions. Maybe you had 30 contracts and you dump 10 just to survive. Price drops. That drop triggers more margin stress for the next guy. Price drops again, and suddenly the market looks like it fell down a staircase. Here's the part most people miss. The margin hike isn't analysis. It's a broom. It sweeps out anyone who's weak, overlevered, or late, and the players with deep pockets don't mind the mess. They love it. Because when price gets shoved down by forced liquidations, someone is standing there with open hands saying, great, I'll take delivery. Now watch this. In past cycles, this margin trick basically kneecapped the move. It didn't just slow the rally, it killed it. And historically, when silver gets its legs broken like that, it takes years to stand back up. But this time, silver got hit, and then it started climbing again. That is not normal behavior for a market that's supposed to be topping. So we have to ask the uncomfortable question. If a margin hike didn't end the party, what does that tell us about the party? It tells us there is demand underneath that is not speculative excitement. It's need. It's physical. It's someone saying, I don't care about your paper games. I want the stuff. And when you see that, you stop looking at headlines and you start looking at flows. Because the real story in silver is always in the plumbing. The pipes, the delivery, the spread between regions, the stuff you never hear about on TV. So let's talk about the 3 forces that are pulling silver in opposite directions right now. And we're going to do it without wasting your time. Force 1, the leverage shakeout. Force 2, cross-border demand and arbitrage. Force 3, forced rebalancing from commodity indexes. And hanging over all of it like a storm cloud are whispers of bank memos that sound like get out before month end and cash settlement only. Even if you think that part is exaggerated, you can't ignore why it spreads. Because fear doesn't go viral unless the system already feels fragile. So let's start with leverage. Fact, margin requirements jumped twice. Interpretation. The system wanted to flush out the small and medium players who were riding leverage like a surfboard. And if you're thinking, so what? That happens all the time. Yes, but what doesn't happen all the time is what came next. Price got shoved and price recovered. That means the bids underneath were real. Not chat room hype, not to the moon fantasies, real demand. Now, what kind of demand shows up right after forced liquidations? The kind that doesn't care about margin, the kind that can pay cash, the kind that is comfortable taking delivery. That's usually the biggest money. The players who don't chase, they wait. They let the market panic, then they scoop. So when the weaker hands get forced to sell, the strong hands absorb it. And that absorption is why silver didn't stay down. But we're not done, because the leverage story is only half of it. The second force is the regional spread. This is where the silver market starts acting like a cracked dam. You can pretend everything is fine until the pressure difference becomes obvious. Here's what we're seeing. There are times when silver trades meaningfully higher in one region than another. If you're a trader with access, you can buy exposure in the cheaper market and sell where it's higher. That difference is called a spread. And when the spread is big enough, money does what money always does. It rushes toward the gap. Arbitrage. Now this is the part that should make you pause. When you arbitrage physical, the metal moves. And in a tight physical market, that metal doesn't always come back. So every time traders exploit a big regional premium, it can quietly drain inventory from the cheap side. And that's one reason you can see price get hammered in the West. and then bounce anyway. Because the bounce is not about feelings, it's about supply. Now, quick question for you. If a market keeps bouncing after it gets punched, who do you think is doing the buying? Drop your answer in the comments, because the way you think about that tells me whether you're watching price or watching structure. Okay, third force, rebalancing. This is the one that gets used as a scary bedtime story every year. Index rebalancing is real. Models exist. Rules exist. Funds have to adjust their weights. So yes, sometimes large funds are forced to sell something that's become too big in their basket. They may not want to sell, but they have to, legally, mechanically, like a robot. And that can create temporary selling pressure. But here's the mistake most people make. They hear forced selling, and they assume it means fundamentals are broken. No, forced selling is not a judgment. It's just a rule. And rules can create gifts. Because if selling is forced, it's often price insensitive, meaning they sell because they must, not because they believe. So who buys forced selling? The same deep pocket players who buy margin liquidations, the same people who can wait. So rebalancing can create volatility, and it can create opportunity. But it's not the core story. The core story is still this: physical demand has not gone away. And now we get to the part that's making this feel different. Deliveries. Let's stay factual. There have been months where delivery numbers were massive, record level, and early in the new year, deliveries can stack quickly. That tells us something simple. When a lot of contracts stand for delivery, it means someone is saying, "Don't cash me out, ship the metal." That is a totally different mindset than "I just want price exposure." It's a buyer saying, "I don't trust the paper promise enough." Now you might be thinking, "Okay, John, delivery numbers can be noisy." True, but patterns matter. If delivery appetite stays elevated while leverage gets shaken out, that's not random, that's transfer. From weak hands to strong hands. From paper gamblers to physical demand. And transfers are how bull markets build their base. Now watch this next part, because it's where the rumors start to make emotional sense. There's talk floating around about big banks sending internal notes. Notes that allegedly tell institutional clients to close silver positions by month end. Notes that allegedly say, after a certain date, physical delivery becomes restricted and cash settlement becomes the default. I'm not telling you to treat that as gospel. I can't verify a rumor inside your screen, but we don't need the rumor to be true to learn from it. We just need to ask, why would that story spread so fast? Because it hits an existing fear, counterparty risk, the fear that the system can't deliver what it promised. That fear doesn't come from nowhere. It comes from the way paper markets are designed. A futures contract is a promise. A promise is only as good as the system behind it. So when you hear cash settlement only, your brain translates it instantly. It hears, "We'll pay you in printed stuff, not metal." And if you bought silver because you want an escape from printed stuff, that's a problem. Now, let's pause here, not to do a recap, to do a reality check. If we're wrong, where will it show first? Will it show in price? Or will it show in delivery delays, widening spreads, weird premiums, and rule changes? That's the question. Because price is the last thing that tells you the truth. Structure tells you first. Now, I want to talk about ETFs for a second, and I know people get defensive here, but we need to be adults about it. In fact, a lot of silver exposure in the market sits inside paper products. Interpretation. Many people think they own silver, but what they own is a claim, and the claim has conditions. Those documents have risk sections for a reason. They spend pages telling you how many ways the structure can protect the sponsor and leave you holding the bag. Sub-custodians, no liability for errors, bars you can't personally inspect. And if fraud or mismatch is discovered, the structure can freeze. Then you might get paid based on an earlier valuation date, not the moonshot price you dreamed of. So here's the clean way to think about it. ETFs are for trading. Physical is for sovereignty. And if you confuse those two, you end up surprised at the worst moment. Now, do I hate ETFs? No, we're not emotional. We're practical. If your goal is short-term price movement, paper is liquid. If your goal is owning metal that cannot be printed, then you need a different approach. And the whole reason these delivery rumors are so spicy is because they strike at that exact difference. They tell you, you may get paid, but you may not get the metal. Now, let's go deeper. Because the real elephant in the room is not a memo. It's the concentrated short. This is where silver stops being just another commodity. For decades, silver has carried an unusually large, unusually persistent short position held by a small cluster of major banks and traders. That's not a conspiracy statement. That's a structure statement, a tiny market, a massive paper pile, and the same names showing up again and again. So the natural question is, why? Why would anyone maintain a concentrated short in a market this small for this long? because capping price can be profitable, because managing volatility can be strategic, because silver is not just jewelry. It's industrial, it's energy, it's tech, it's supply chain, and in some corners of the world, it's also strategic material. Now, I'm not going to feed you cinematic fantasies. We don't need that. We just need to accept one simple reality. If too many people demand physical at the same time, paper markets get stressed, because the paper market is designed to be a river of claims, not a warehouse of metal. So the system relies on most people never asking for delivery. Most people just trade the promise. And that's why elevated delivery appetite matters so much, because it tests the system. And when the system is tested, the system often responds the same way, with rule changes, higher margins, more cash settlement, more for your safety policies. Now here comes the part that can make this go viral, because it sounds crazy until you look at history. Every time silver starts to behave like it wants to break loose, we see a familiar pattern. Price spikes, leverage piles in, then margins rise. Then price gets smacked. Then headlines scream, top is in. Then the strongest hands quietly take metal off the table. That's the cycle. But this time something is off. The smack happened, and silver didn't stay down. So we need to ask, are the old tricks losing their power? Because if the old tricks stop working, the next move can be violent. And I don't mean a little higher. I mean the kind of move that turns risk managers pale. Now, we also have a seasonal ingredient, the so-called January effect, new allocations, fresh capital, funds redeploying. Some of that money is required to go somewhere. And when a market is already tight, new money doesn't just add interest, it adds pressure, like pouring water into a bottle that's already full. Now, I know what you're thinking. John, does this mean silver will definitely explode? No, we don't do fake certainty. Here's the certainty ladder. Certain. Margin hikes happened, and the market absorbed them faster than usual. Likely, physical demand remains strong, and the system is trying to control volatility. Possible, if delivery stress grows, more rule changes will appear. Risk. If liquidity evaporates, price can whipsaw and punish both longs and shorts. So we're not saying guaranteed moon. We're saying the setup is unusual and the behavior is informative. Now let's talk about the date that keeps showing up in these rumors. End of the month. The idea that by January 31, something changes. Whether that's real or not, the market treats it like a deadline. And deadlines are fuel. Because if traders believe a window is closing, they rush. And rushing creates moves. So even the rumor can become a catalyst. Now, this is where we need to be calm. Calm doesn't mean passive. Calm means precise. We look at how the market reacts to stress events, margins, rebalancing, regional spreads, delivery appetite, and we ask, is the stress being resolved or just postponed? Because postponement looks like relief, right before it turns into surprise. Now, let's do the explain like you're smart part. One metric in one line. Open interest is the number of outstanding contracts. Why it matters. It tells you how crowded the trade is. How we apply it here. When open interest stays elevated while inventories feel tight, it can mean a lot of paper claims are stacked on a limited physical base. That's when small disruptions become big stories. And if you're wondering why silver feels like a heart monitor right now, it's because it's a leveraged market sitting on a physical constraint. That creates volatility. Not because silver is crazy, because the structure is fragile. Now watch this next clue. When silver gets hammered by forced selling, you'd expect the story to end, but instead you see buyers show up. And not just any buyers, the type of buyers that don't care about short-term dip drama. The type of buyers that are happy when price drops because it lets them accumulate. So the market becomes a battlefield, paper players pushing price down, physical demand pulling it back up, and the tug of war makes charts look insane. This is exactly why people get emotionally wrecked in silver. They treat it like a normal stock. It's not. It's a war between leverage and inventory. Now let me tell you the mistake most people make right here. They wait for certainty. They want the headline that says, yes, the breakout is confirmed. But by the time the headline is comfortable, the move is gone. And then the same people chase at the top, get margin hiked, and become the liquidity for the strong hands. We're not doing that. We're not gambling. We're measuring. So what are we watching from here? First, margin policy and how quickly the market absorbs it. If price keeps recovering after margin hits, it tells you forced selling is being absorbed. Second, regional premiums. If the spread stays wide, it signals the physical market is still pulling metal. Third, delivery appetite. If more contracts stand for delivery, it signals the desire for metal is not fading. Fourth, the tone of institutions. If big players start telling clients to reduce exposure, that's not